Researching all of that, what has been learned from the legends and the market history and the historical stocks. So here's just some bullet points that we'll go through each one of these. And you know, a lot of the traders you've had on this conference this weekend and last weekend, you know, we see this a lot. These are top traders. They're doing this too. So these are some of the key points to take into consideration and to really refine. If you're having trouble, which a lot of people can get into trouble, and just because you succeed at some point doesn't mean you can't fall back. I'm going to give this quick example before we jump into this. I was looking up this the other day. So Baruch, 1927, 1928, the market is ripping high. Baruch is like, he's in GM, and he says, I think GM is too high. Okay, now what's he doing wrong here? The market is ripping, and he's making a personal opinion about GM. And he's been in the market for what, 30 years by now? Made a lot of money in the market. And he's like, no, this is too high. What does he do? He sells his position out and he shorts the stock. It goes against him, he shorts more. It goes against him again and he shorts even more. He lost 400 grand on that transaction when he finally realized, what am I doing here? I'm breaking all my rules and I'm not following the market. I'm going against it. So even if you're Bernard Baruch at that stage in your career, you can still make mistakes. We all do. This is a tough game. This is, you know, Gerald Loeb called his book The Battle for Investment Survival. It is a battle. And it's not easy, but, you know, you learn from your mistakes and create rules that don't break, or that you don't bend or break them, and that'll get you back on the right track. So back to this. So risk management is job number one. Limit your losses. Hope is not a strategy. I had that, you know, when I bought this stupid stock on CNBC, I just kept hoping, oh, it's going to come back. The guys on CNBC said it would. So hope is not a strategy. Take your loss and get out. Accept the fact that you will be wrong more times than right. O'Neill was, when I was doing monster stocks and I had to send my edits back to William O'Neill because I wrote about him, and of course he had to approve what I wrote about him first. And I was like, I wonder how many times he's been right. So I put in there a number, I think, and he came back with the edits. He sent them back to me and he corrected it. He said he was right like 65% of the time. Wow, that's pretty impressive. I mean, 50% is impressive. 65, I was like, you're the GOAT, man. I mean, that's what I thought. So, but you're still going to be wrong a lot, and it's to fix those times when you're wrong by taking your loss, and going to the sideline, and thinking about what you did wrong, et cetera, et cetera. So, of course, stay in sync with the market. We're seeing that today, and we're going to get to that in a little bit because there's a great example coming up. So make sure the wind is at your back. And then this is something that I talk about a lot on Twitter. Check the new high, new low levels to help determine the strength or weakness of the trend. Some people dismiss this. That's okay. But this is not something I made up by any stretch. This goes back decades. There was a book written in 1965 by Gilbert Haller. It's called The Haller Theory of Stock Market Trends. And Richard, I got that book from an interview you did with Williams. And he said that book was the first book he ever bought that influenced him. And I was like, wow, I don't know about that book. So of course I go find it, and I have to find the original. So I don't want to, I like the original copies. And he has in that book, he's got 20 years of the Dow from 1942 to 1962, every year, tracking the Dow average with the new high, new low numbers right below it. And they're totally in sync with each other. So he tracked that. Then staying in sync with the market. Hit the gas when the strong uptrend is in place. When all the averages are above their moving average line. 200, 50, 21, 10 days. That's when the market is ripping. There are three main economic issues that are anticipated or reflected by the market: inflation, interest rates, and GDP. So keep an eye on it. They're making headlines every day today. The same thing that caused all the downtrends in the prior eras are causing the same thing today. Choppy markets, Livermore always said, that's when he went fishing. He goes, choppy markets will cut you up. That's the 1,000, cuts by death thing. And a lot of those guys, Darvish wasn't in choppy markets. If he wasn't seeing breakouts through his box theory, he stayed out. So, I mean, I've been out most of this year just because it's too choppy for me, but a lot of guys are still making it, which is great if you can do that. But in a downtrend choppy market, I think it's a lot more difficult. Then this point, I think, is the key to everything. Well, they're all key, but this one's the time-tested strategies to your own system and personality. So what are the commonalities of those legendary traders? Concentration versus diversification. All those guys held between 5 to 10 stocks at any given time. That was it. If you want to really see a textbook example of a great stock trader, read the Darvish's book, How I Made $2 Million, the end of the 50s, 58 and 59, when he made most of that money. There was a time in 59 where he had his first $500,000 in profit. So he had some capital to work with. What he did was he took so the market's now ripping in 59. And he sees that, and he sees stocks breaking out and going to the upside. He buys 4 positions, 4 stocks. He puts tight stops on those. He gets stopped out of the first one, I think, within like a week. The second one wasn't acting how he wanted to, so he cut it. So now he's down to 2 stocks, and those start taking off. What does he do? He takes the money from the 2 he sold and piles them into. I mean, he pyramided up the whole time at 59. And those 2 stocks were it. That was the bulk of the rest of what he did. So concentration, low with Montgomery Ward, Chrysler with in 62 with Baruch and Loeb and O'Neill, same thing. Look at O'Neill in 98, 99. Man, he made some 300, 400% returns in those years by being concentrated in, Charles Schwab, AOL, Qualcomm. Those were massive leaders for him. And in 99, you had tens, 30, 40, 50, 60 stocks racing. But he concentrated in just, a handful. Then get your mind right. That's the key. This first line, the battle is not you against the market. The battle is you against yourself. So if you think about that, that's really true. When you're losing, it's not because of the market. It's because of you. What you did. You didn't cut your loss. You didn't do this. You didn't do that. You don't have to be in the market. So you need to get your mind right and make sure that it's you against yourself. And then learn to trust your intuition and control or stifle your fear, anxiety, elation, and recklessness. I got that from Wyckoff. Those were the 4 key traits that he said, those are the ones you need to control. So, all these things, get your mind right, strategies, fit your own system. And then I love this one, make sure the trio traits, the 3 main traits are in balance. This comes from Mark Douglas. I think Trading in the Zone is to me, that's the master psychology book on trading. I know some people think it's a little difficult, but there's so many good nuggets in that book. So the trio traits that he talks about are discipline, patience is the key, create rules that don't bend or break. So here's the thing. You're in the market. There's no boss in the market. There's no restrictions on what you can do except how much money you have in your account. So I worked for companies for, 30 years. Every company, there's rules. You can't do this, you can't say that, you can't do this. And you know what those rules are, so you don't break or bend the rules or they'll fire. Well, in the market, there's no boss. You can do anything you want, which is pretty dangerous. So that's why you have to create rules and stick by them. But what happens is, because we're all human, we bend them and then we break them like Baruch did. I mean, after all that, I mean, what a huge loss that was, but he broke his rule. He knew that was wrong, but we do that. So you got to stick to those rules. And one thing that always intrigued me was, you know, How to Make Money in Stocks by O'Neill. That was a turning point for me and lots of traders. It's a great book. But I always kept wondering, how come in that book, O'Neill never really talked about the psychology side? He really doesn't. He talks about the fundamentals a lot. He talks about the technicals and all those other things, but he doesn't really get into the psychology and the mental attitude of it. And I figured out why. It's because on that slide I showed earlier where he said, what were the things that turned it around for me? He studied his mistakes and then he made these rules. He was just such a strict disciplinarian. I think his adage was, if I'm going to make these rules, then I'm not going to break them. So it's hard to do that, but he was a master at that. So he's like, why create the rules if I'm going to break them? I think it was just easier for him. So there's the point. Create rules that don't break or bend. And then focus. Another one of the key traits from Douglas. Shut out all the noise and opinions. Price and volume will speak to you. Listen up. So I say add historical analysis to your technical, fundamental, and psychological analysis tool. You kind of do that a lot with technicals, because a lot of people go back and look at history and how the base created and it looked like this, looked like that. But history has such a way of repeating itself so many times that I just think it helped. It helped me, and I'm writing these books so I can help other people.